Last week, it was Finsbury Growth and Income Trust's annual general meeting, and I presented to assembled shareholders. There were three things that I really wanted to convey and that I was candidly proud of. The first was to note that 2019 was the 19th full year of Lindsell Train Limited's responsibility for the investment affairs of the company. That now means, now we're into 2020, we're into the 20th year of our responsibility. That's a long time. And as I say, we're proud to have retained the confidence of the board of the company and shareholders for so long. Second thing to note about 2019 was that I hope you regarded the performance of the company as, well, at least acceptable. The net asset value was up over 23%. Compared to the benchmark, which is the FT All Share Index, up just over 19. So, yeah, a decent year of outperformance, which, given the turmoils and ups and downs of 2019, in the end was an outcome that we were pretty satisfied by. And then finally, putting last year's performance into context of, let's say, the last decade, I have to highlight the fact that having outperformed in 2019, that means for 9 out of the last 10 years, Finsbury, or our stewardship of Finsbury, has led to outperformance. Now, great news, you might think, and obviously we're pleased about it. But I think no one should be under any illusion. Certainly we are under no illusions that if you outperform a benchmark like the FT All Share Index 9 years out of 10, if you do, you are doing something very different. Yeah? You're structuring the portfolio in a way very different from the average or different from other investors. And that is certainly the case. You know, even a cursory examination of Finsbury's portfolio, and you can see that what we are doing that is different is we are managing a highly concentrated portfolio. We only have today 22 holdings, and that truly is concentrated by the standards of, well, many other investment trusts. Now, we think it's an important mitigation and an important comfort that what we've concentrated the portfolio on are big, reliable, conservatively run household name businesses. Now just think about this. If I just mention 5 companies to you: the London Stock Exchange, Reed Elsevier, the world's biggest scientific and legal publishing company, Diageo, Unilever, and Mondelez, the company that owns Cadbury and Oreos. I've only mentioned 5 companies. I think you'd accept that those are pretty well established household name businesses with some fantastic brands. But just with those 5 names, I've already accounted for nearly 50% of the net asset value of Finsbury Growth and Income Trust. So, you know, as I've said, it is a concentrated portfolio. I think where I'm going with this is, what I want to say is that portfolio concentration on what we analyse to be very reliable, durable businesses, that portfolio concentration is what has generated our outperformance over time. And yet I want no shareholder to be in any doubt that that concentration can bring risk, volatility of return, possible risk if one of those big names were to have a tougher time. So I think it's important for me as the manager to want to ensure that shareholders do understand this and to encourage shareholders to have a diverse range of holdings of investment trusts as they feel appropriate to ensure they have enough diversification for their own portfolios. The great Warren Buffett says somewhere that if you have new money to invest, that very often the best new investment to buy is to buy more of what you already own, particularly if what you already own is a fine asset or a fine business. And absolutely, those of you who followed Finsbury will know that we have taken that advice. We very rarely add new holdings to the portfolio. Having said that, every so often we do come across new ideas that we think it's worth acting on. And indeed, over the last 6 months, we have initiated 2 new holdings for the portfolio, both in a small way to date, both holdings that we're only very gradually building up. But nonetheless, we have started 2 new holdings, and I thought that this was an opportunity just to reveal to you the identity of those 2 new ideas and just discuss some of what it might take to make us start a new holding. So the 2 new holdings are PZ Cussons and Fevertree. And yeah, I think that there's a number of things in common about those 2 companies, but I also think that both of those companies are in their own way absolutely classic Lindsell Train type businesses. Perhaps most importantly, both of those companies own some outstanding brands. When I think about PZ Cussons, I tell you what I think about most today is PZ Cussons' ownership of Carex. Do you know Carex? That's the UK's #1 antibacterial hand wash with an over 30% share of that category. And in today's hygiene-conscious times, that's a very nice brand for PZ Cussons to own. Imperial Leather is another well-known PZ Cussons brand, and Saint-Tropez, the fake tan product, I use that all the time. But actually, seriously, Saint-Tropez, that's a very rapidly growing and valuable brand. Meanwhile, of course, with Fevertree, I know that none of you would dream of mixing your Tanqueray with anything else but Fevertree tonic. Tanqueray, of course, being Diageo, one of our big holdings, Diageo's #1 global gin brand. So both of these 2 companies own some exceptional brands, in our opinion. But the second thing that, the second similarity perhaps between the 2 is that for a number of reasons, both of them have had notably weak share prices in recent years. PZ Cussons' share price is down, about 60% in the last 4 or 5 years. And actually Fevertree, as some of you may know, has seen an even more precipitate share price fall than that. It too is down, 65%, and that's pretty much in the last 18 months. Indeed, Fevertree shares were down nearly 30% in January of 2020 alone, and it was that really made us sit up and pay attention to that opportunity. And what I think is so important for me to communicate here is that there are understandable and justifiable reasons why both PZ Cussons and Fevertree should have suffered relatively weak share prices in the last few years. Both companies have certain issues, and we don't think either of those issues are going to go away in a hurry. PZ Cussons, its biggest emerging market exposure, which is Nigeria, is going through a very tough time currently, and we see no immediate signs of recovery there. And for Fevertree, its biggest market, which is the UK, of course, there was a marked slowdown in its sales growth in the UK last year. But I think the point is this. I'm not tipping these shares to you. We've not begun to accumulate what are still small holdings for Finsbury. We've not begun to accumulate because we think they're about to rebound and go up a lot in the short term. We've begun quietly and gradually to build these holdings because to us it's our job, it's our discipline when companies own brands as strong as this and go through a tougher period. We think we do our job well if we try and take advantage of the sort of bargains that I hope are being presented.